sector by sector, also company by company. Even within the consumer sector, you'll have companies that have already, over the last 2 or 3 years, put through a lot of price increases and probably don't have that pricing power anymore, versus others, whether it be the desirability of the goods or what they've done in the past, that will demonstrate strong pricing power. The margin profile in the US still ultimately does come down to technology companies and also AI adoption through the economy, which is where we think the productivity gains and therefore the operating leverage will come to support margins.
So if we think further down the line then to this optimism that markets are seeing in terms of growth, and the questions of fiscal stimulus, particularly in Europe, have been in focus for several months now, is what essentially companies are telling us is that they believe that money will come, and it will come in time for, the medium term, because there's already questions about how some of these promises are going to be paid for.
Yes, I think when it comes to the European infrastructure and defence spending, then we are reasonably constructive on that. The companies we're talking to, particularly industrials, defence companies, many of the German businesses, they are pretty optimistic and already seeing across a range of products, order inflow that will give order book security, the potential for aftermarket sales as well. So, whilst I think overall this kind of fiscal spending is typically not a high multiplier effect, i.e. it's not going to be magnified at scale across the economy at large, I do think it will be sufficient to mean that industrials, particularly, as I say, the German industrial complex, can do pretty well, and that will be a draw for capital to Europe, along with the ongoing rebalancing that's happening across the institutional space, with still pretty heavy dollar overweight positions.
We spoke to Catherine Nice over at PGIM earlier on Bloomberg TV, Grace, and she was pretty relaxed about European fiscal levels, suggesting that Europe as a whole is not in a tricky position. Of course, the politics, she acknowledged, gets much more complicated than that. So when you look around the world, are you a lot less concerned about Europe than you are, say, the United States or the UK and other places?
Yes, I think so. I think Europe's going through a phase now where policymakers have recognised the opportunity, which is to, that in the past they've over-regulated companies and under-regulated national security, and that's reversing. And I think that the opportunity is to have, sort of more of a common legal and regulatory framework, to cut some of the red tape, to make innovation and doing business in Europe easier. And I think that would obviously be very positive for growth, for sentiment, for the region. So the mindset shift is there. It's nascent, but I think it's there. And certainly this stimulus should be a bit of a boost. Let's call it 50 basis points on GDP looking out to 2026 and beyond. But that does still close the gap between the growth differential between Europe and the US, which is one of the key things that investors look to when allocating capital.
In terms of the allocation question, you've talked to us before about resilience in portfolios. Where is the resilience to be found in this moment?
Yes, well, equities are proving resilient. So, we've always said that resilient portfolios does still start with a 60-40 stock bond portfolio. You've also actually had good returns out of the bond component this year, whether you're talking about treasuries or even high yield markets. So I still think that stands. Where we want to build in resilience is in private markets, for a hedge for infrastructure as well as less correlated income. So that would be infrastructure as an example, or through assets that can monetize volatility, which we do think you're still going to get, bouts of volatility. So that would be in gold, in hedge funds, and also in structured notes.